everyone. Just going to wait a few minutes for some more folks to show up. Give everybody a chance to get settled in. Hello. Feel free to take yourselves off mute. If you'd like to introduce yourselves or, start shooting some questions, we can go ahead and get started anytime you guys would like. You can have video on too. Don't be afraid of me.
Hi, everybody. My name's Courtney.
Hey, Courtney. Hey, Brian.
Hey, Bobby. How you doing, buddy?
I'm doing well. I hope you are.
I'm doing well, sir. Thank you.
So I like these to be just real interactive and just, people kind of, saying, asking anything that's on their mind. And there's my gratitude alarm going off. So.
Hi. I'm going to be
Larissa.
driving, so I don't know how interactive I'm going to be, but I'm listening.
That's cool.
Yeah, so I'm super curious about this because usually people talk about houses and multifamilies and all those things. I live in New York City, and it's quite expensive to do much of anything here. I have an apartment that I own and kind of live in. I do locums work, but definitely interested in creating an alternative source of revenue because it's, the OR days are long. But I feel like I've been trying to listen to the bigger pocket stuff, but it's like going to ask you just go get a sip of water from a fire hose, and it's just like so many things to do, information. So
yeah.
I'm curious to learn about this, but I'm gonna turn my camera off and just listen because I'm gonna drive.
That's cool. So yeah, the Real Estate Guys podcast is a pretty famous, couple of guys. They've been doing this for a long time, and one of their favorite mantras is, live where you want to, but invest where it makes sense. And so, that's my mantra as well. I live in North Carolina, and, so I don't have the problems that you might in New York, but I invest in 4 different states right now. So
oh, wow.
That's just something that, it works for me. And I'm all about spreading my risk out across different areas and stuff. Hey, Dave. But yeah, it's for me, I like to diversify across different asset classes. So, A, B, and C properties. And I can go into more detail about what those actually are, if you'd like me to, but also across geographic areas. And that way the markets, in one area aren't dominant in my particular portfolio. So
I've heard about that, but there's definitely things to research and look at the cities that you don't live in, especially if they're not easy to travel to. And I looked briefly at some Detroit things, and there's a lot to make sure you don't buy a bad property. So for me as a beginner, it just seems really overwhelming, to think like it's hard to go check on things, and then horror stories of property managers and all those things. So it's a little intimidating.
Absolutely. So with apartment investing, the difference here is I compare it a little more to investing in the stock market, in the sense of you're buying a company. You're putting your faith in a group of operators to be able to carry out a business plan when they purchase a property. So as a passive investor in an apartment deal, you're part of the limited partnership, and then you've got the general partners who are the operators of the business plan and the deal. So they analyze the different deals across different markets. A particular operator may primarily work in, the Southeast, or they may primarily work in Michigan, in that, Detroit, Ann Arbor kind of area. That may be their thing, is working more in the Midwest. But the most important thing when you're talking about operators, that you want to make sure they have a track record of success. You want to talk to them and see, what has happened in the past that, has worked for you. You really don't want it to be kind of their first go round, because then they're kind of learning on your dime. So, part of what I do is I only invest in operators that I have vetted and I trust. So, because you can have just a screaming deal that comes across, but if you don't have a good operating team, then it doesn't matter. They can't carry out their business plan. So Matthew just sent in a question: with syndications, does the investor actually own the units? Or a better question, how is the investor's money protected? So as far as actually owning the units, so you own a piece of the business that owns the property. And that's how that works. It's something that allows you to actually get the benefits of owning real estate without actually, having a deed to a property or anything like that. So you get all the tax benefits that come with owning a piece of property. As far as the depreciation, the bonus depreciation, cost segregation analyses that are carried forward that allow you to have a lot of tax benefits to owning this property and allow you to write off a lot of the passive income that comes from owning properties. But as far as actually owning units, you own shares of a company that owns the units. And so typically an operator will create a separate LLC that will go out and purchase this property and execute a business plan and pay investors along the way. And that's how that works. Does that answer your question, Matthew? Or you can type it in the box if it does, or doesn't. And so yeah, that helps. Okay. So yeah, Larissa, did you have other questions, or Brian, or anybody else really?
Not at the moment. I'll just be mostly listening because I don't know very much about this at all. So
Gotcha.
all information is welcome.
Yeah. So, typically what you're looking at with a typical deal, and I say typical, but things are changing, but you're looking at 6 to 10% of cash distributions that you'll get either on a monthly or quarterly basis, given, it just depends on the deal and how they've got it structured. So you might get monthly income, you might get quarterly distributions from that. So for instance, if you were to invest $100,000 into a deal, you would expect to get between $6,000 to $10,000 in distributions every year from that deal during the time that you own the deal. Okay. Every deal is different. They're all kind of underwritten differently. So you'd have to look at a specific deal to understand that. But the general idea is that you get that return kind of up front. And during that time, the operators of the building are going through, they're renovating units, they're managing the property differently, whether or not they're taking care of reducing costs of management, fixing problems with, collections of rents, trying to boost the occupancy numbers, things of that nature that all make a difference in the underlying income that you make on a property. They're raising rents. So the big thing is you want to raise your net operating income and you want to lower your expenses. Okay. You want that gap to widen when you own a property. And that's the general idea. The value of an apartment building is different from the value of a single family home. You can take the same exact home and have it in a suburb of New York, and it's going to be a lot more expensive than in a suburb of Winston-Salem where I live. Okay. But in general, the apartments are based on how much income you can produce from that property. So let's say you have a $500,000 home in New York, but it's only able to net you about $2,000 in rental income per month. Well, if you took that same home and put it in Winston-Salem and, say it's only worth $250,000, but it's still getting you that same $2,000 of income, then those apartments would be worth the same thing in the eyes of the bank. Does that make sense? I shouldn't ask questions. Everybody's on mute. But yeah, there we go. Thumbs up for the folks on video. But yeah, so that's the general idea with apartment investing, how it's different from single family. So you can, basically put your money into an investment and it all depends on the net operating income that they're able to produce. And that's what you're trying to, you want to invest in operators who know how to maximize that income, whether that's through reducing the expenses or increasing, revenues through different business plans. One of those examples in higher end properties is putting in what's called Gigafy. And that's an internet service that just branches throughout all of the apartments. And so then you can get people who are renting with you, you put it as part of a package deal. And okay, so your rent's going to be 500, well, let's be realistic, $1,000 a month. And this service is going to cost you $75 a month to have all your internet and everything taken care of, high speed internet and everything. So people will elect to use that service instead of trying to go outside of that, because it's just easier. And so that's extra revenue that you bring in, because it only costs you, say, $30 to have that service, available to them. So there are different methods, different ways that operators can increase that income over time. And that's something that, each operator is a little different in how they approach it. And it depends on the property that you get. So A properties are the creme de la creme. You've got those in, the best markets, and basically where, people with high paying jobs are, and you've got a lot of high employment, high income employment. So those are your places that have more amenities, more things for people to do in the area. Your B and C are the next levels down. So your B markets are, basically, hey, you're working class, you're blue collar, working class folks. And then you've got C, which is just kind of a step below that, still blue collar folks, but maybe just lower paying jobs, but, still able to, it's not a bad market to be in, as far as having plenty of people that are ready to rent for you. So each of those is different wherever you go. Real estate is local. So it really depends on where you go and where you're wanting to invest, and where your operators are. It's one thing to have operators out in Arizona and they're doing a great job out there, but then all of a sudden, if they're showing you an offering that's in Florida, well, then you got to ask yourself, okay, why are they showing me something in Florida? Do they have the right team in place to take care of this property the right way that they would where they actually are in Arizona? What are the similarities? What are the differences? Stuff like that are all good questions to ask. So if anybody's got any other questions, feel free to kind of shout them out or put them in the chat. I see we've got another one. How many apartments does your company currently own or manage? So my company does not actually own or manage any apartments. That's not my business model. So what I do is I work with different operators across the country. So they are the ones who own and manage properties. I present those investments. I go through and I vet those investments for, my investors. And that way you kind of have that second layer of protection, for folks that have talked about, well, I just don't know enough about this. I don't know how to vet somebody, well, that's what I do. That's why I'm here. I work with folks who are, really well known in the business. They've been doing this for a long time. They've had a lot of success. And so I work with them to bring these offerings to other folks, to my investors. And so I in turn raise capital for them and, bring revenue to the table, or not revenue, bring, basically money to the table, capital to the table for them. And basically I'm able to get in on a deal based on, my ability, not just to bring capital, but also to be a part of the, I would become a part of the management team when I bring capital to them. So I would be looking over all the reports, and that's part of my job, as having investors. I want to help you make money. I want to protect you. I want to keep you guys in the loop. And so my job is to keep you guys abreast of what's going on and to stay on top of the business plan that they're actually executing, and that I would then be a part of and make sure that things are being done the right way and all that kind of stuff. So that's kind of what it works, or how it works. So let's see. So Courtney, you typed in, completely new to this question is, how much capital do you need to start investing in apartments and what steps you would need to take? And so this is a two-parter. So we'll start with that first part and I'll get to the second part after that. So basically most of these deals are $50,000 to invest. Now, I am working with some partners that we're trying to see how we could figure out maybe a first-time deal where we reduce that amount for first-time investors, but we haven't solidified any of those plans yet. So I can't promise anything at this point. But you know, for a lot of folks, you know, $50,000 is a lot of money. You know, for most folks, it's a lot of money. So, you know, that's something that you know, we're trying to maybe reduce that for people who get into it for the first time. But from a management perspective, from an operator's perspective, you would rather have people who have larger amounts of money, because then you have fewer expenses associated with keeping track of all of the tax forms and, you know, all those kinds of things. And just keeping everybody abreast of what's going on with it. You know, it's easier to keep track of 10 people than 100. So, as far as what steps you need to take, the steps that you need to take are just educating yourself in general about what these kinds of deals look like. You know, what you can expect from deals. Ask questions, being curious. That's the biggest thing that you need to do if you're looking at having you know, or investing with me or investing with any operator out in the space. You want to be able to get on the phone with them and ask them questions about whatever offering it is they have and about how they practice in general. You want to see a definitive track record of results, where, you know, talking to previous investors who have worked with them in the past. So those are all things to consider getting into. I hope that answers your question, Courtney. I'm more than happy to go into more detail here in a little bit if you have other questions about it. But second part of your question was mentioning that I was a CRNA previously. So yes, I am now a retired CRNA. I haven't worked in about 1.5 years. And so that's something that basically, you know, my 1099 work was drying up and I was having to kind of make choices about where I wanted to work. And a lot of those places were unsavory, that I had, you know, options with. And so I didn't want to go into places where I didn't feel comfortable. And so at that time, I was already looking into making a transition out of anesthesia and into, you know, having more passive income anyway. So what ended up happening was I had a situation where I hadn't worked at a particular hospital for a few years, and my children had gone to the daycare center, the preschool that had been set up there for years. I have 3 children. You know, we started with our youngest, who's now 10. She went all the way through preschool. The second, you know, our son went through preschool, and our youngest daughter was in preschool. And they went through a management change, found out that, you know, well, we had just worked it out with the previous management that we'd keep our kids in, you know, so long as we were paying. And they had new management. They said, well, you don't work for the hospital, so we can't let you stay here. So they gave us 30 days. And, you know, around here, you can't find preschool for, you know, in 30 days for your children. So I became a stay-at-home dad at that point and just haven't really looked back. I had already set up some side income, so I just continued to do that. I cashed out much of my retirement funds in order to create passive income. You can invest with retirement funds. We've done that with some of my wife's funds as well through her IRAs. But with my funds, I wanted to produce income so that I could feel comfortable staying at home. So that's a little bit about my beginnings as far as real estate. Now I've gone through the gamut of looking into, you know, plan Bs, side hustles, stuff like that. I looked into options trading. I looked into wholesaling. I looked into single family rentals, which we do have one down in Alabama, and it's working now, but it didn't work well for us at the very beginning. And so it took time to kind of get to that point. But yeah, that's just, I was a nurse. I graduated in 2006 from UW Oshkosh, graduated in 2011 from the Wake Forest program of anesthesia, and worked here in Winston-Salem and other areas in North Carolina for my entire career. But good question here. Is there a conflict of interest if you're representing the investors and also part of management? There can be. And that's why the deals that I invest in, or that I have investors for, I also invest in myself. I'm putting my money alongside yours. So if the deal goes south, I lose money. That's how I run things. And also the idea of apartment investing is different from a lot of other businesses too. And this is something that's kind of a big point. So it's set up, when you work with good operators, everything is set up so that everybody wins or everybody loses. So, the operators of a property, they're putting their own money into, they're being investors as well. And so when I'm on a general partnership, I am an investor as well. I've put my money into the deal. And so I can stand to lose money if they don't execute the business plan properly, because I'm a part of that team. So that means I'm not executing the business plan properly. And so then we don't make the income that we expect to make. The investors who are passive are the ones who get paid first. They get paid before the management team gets paid. So that's typically how these are set up. So as far as having a conflict of interest, the interest is in getting the passive investors their returns. That's where the crux is. So a good plan, a good apartment offering is all about the residents, getting them a better place to live and getting them updated amenities, a nicer, a nicer apartment in general, better, playground equipment, all kinds of things that you can put in to make that value better for them. That in turn allows the management team to increase rents. Okay. It's a better place to live. And so they can, you typically are buying an offering that's already kind of below market rents. So you want to raise those up just to where the market's at. So that's kind of step two. That's the second part of it. And then number three is again, that the management team, they don't really make any money until the passive investors get paid. And so, those distributions are the key. And then also the payout on a sale of a property. So going back to a little bit of how these are typically set up. So, as a passive investor, you put in, your let's just keep it easy, $100,000. Okay. And you're expecting these cash distributions to start. Depending on the deal, those distributions may start within 3 months or they may start a year later. It just depends on kind of the heavy duty lift that's necessary for a property. For instance, the hotel conversion that I sent out where they're converting a hotel to apartments, that's something that is obviously that's a heavier, kind of a flipping job. So they need those cash reserves to actually implement the business plan. They can't just, as soon as you get into the deal, they're going to start paying you distributions because they're not making money yet. They have to convert these to apartments. So that's part of looking at a deal, is figuring out when you're going to get your money. Okay. Then you've got the hold period for an apartment building, where that's the time period where your investment is expected to last. Okay. So most of them are on a 5 to 7 year hold period. And the idea is that between the cash distributions and then the sale at the end of that 5 to 7 year period, you should be making returns in the 14% or more range. That's in general for most apartment deals to make them worthwhile. Now, that's something that there are refinances that you can have along the way. So a couple of years in, they've implemented, let's say 60 to 70% of their business plan. Rents have gone up, and they're able to go to a bank, and there's extra equity in the property now because the operating team has done a good job. Well, now you can get a cash out refinance, which is just like getting one for your house. It's a non-taxable event. So you can get some of your capital returned to you. So if you invested that $100,000, you might get anywhere from 30,000 to 60,000 back right then in that second year. And you would still continue to get distributions according to the amount of shares that you own in the deal. So at that point, you've got your cash back, then you can maybe redeploy that into another investment if you'd like. And then you can kind of start to build the snowball, because now you're getting cash distributions from 2 deals, but basically still using the same pot of money that you had at the beginning. So that's one way you can snowball it. But at the end of a deal, they will sell the property. And so you will get the remainder of your capital back, and that's not taxed. And then whatever extra you get back would be taxed at capital gains rates. I hope that kind of maps it out a little bit for everyone. Any more questions from folks? Feel free to put them in the chat, or, just shout them out, take yourself off mute, whatever you got for me. So glad to have everybody here. And Courtney, I hope I answered your question well enough.
Yeah, you did. I actually had a few follow-ups. So I'm actually in Kernersville, so I'm like 20 minutes from one.
Oh, cool. That's awesome.
So I was thinking, so right now I'm saving for a down payment for a house, but I was thinking, do you think it would be a wiser investment to use that capital instead to invest in apartments? I mean, honestly, this is just super new to me. And then, I mean, if you have any resources that you could recommend that I can educate myself better, that'd be great.
Yes. So that's a great question. So, Courtney, are you a CRNA, or did you get?
So I'm a clinical research associate, actually. I'm not sure.
Okay. That's fine. Yeah. The sometimes with Meetup, I can't tell who's what and what's who and stuff. So, cool. Well, glad to have you here. And, so as far as, giving advice, I don't know enough about your financial situation to actually feel comfortable giving advice. I will say that the idea of purchasing assets to pay for things is kind of how I go about things. So for instance, if I wanted a car, well, I'd rather purchase a single family rental and that covers my car payment. And then at the end of the 5 or 6 years that it takes me to pay for the car, then I've still got the rental property at the end of it, So that's kind of how I do things. Now, as far as having a down payment for a home, one of the things that you might want to think about, and this is not, it's not really apartment investing, but I don't know. Have you heard about house hacking? Have you heard that idea?
I have, but I'm just one of those people that's really particular about how they live. So I wouldn't think that's a potential option for me.
Okay. So in that instance, I guess what I'm thinking of is more buying a multifamily, like a duplex or something like that. Is that something that is still kind of out of the realm of possibility for you?
Oh, potentially. I'm open to ideas. I'm just trying to think, because I've read, a lot of like Rich Dad Poor Dad and all of these other books, and I'm trying to think what's the best strategy, because, your house is really a liability. So if there's a way that I can make passive income, I'm thinking maybe it would be better to take like 50 grand and put it into apartment investing. So
again, the idea behind that would be that you would start getting those distributions. So if you put in 50,000, you would expect to get, around $300 to $375, maybe $400 a month. So that would certainly help you with making a house payment. I don't think it would cover your entire mortgage. So, right now the rates of, the interest rates are just, near the bottom of what, has been out there. So I don't have a problem with somebody, purchasing their first house. I think the important thing would be to not necessarily keep all of your equity in that house. A lot of people do get into that mindset of like, I've got to pay off my house and I got to get out of debt. There's good debt and there's bad debt. So my thought is, if you can take some of the equity from your own home and then use that to invest, then you can cover some of those mortgage expenses in that way. But, I think it just depends on the size home that you're looking at, what you want, what you need, the market that you're looking at, if you're wanting to stay in Kernersville or if you're wanting to go somewhere else. But yeah, I'd love to, I'm not sure if I'm answering your question, but that's kind of where my mind goes with that kind of stuff. I mean, I own my own house and, we've refinanced to take money out of it. And, we've used some of that to make improvements to the house and then others to try and invest as well.
Okay. So what I'm hearing is that you would just need more information just on my individual situation to figure out what the best plan would be.
Probably. Yeah. Yeah. So, but I mean, and I think that the thing that this comes back to is there's more than one way to do this. There's, there are literally hundreds of ways to go about it. So, as far as how to position yourself and the advice that you want to get, it sounds like you're already doing a lot of research on your own. I'll be honest, I read Rich Dad Poor Dad and I was like, I don't get that. I read it in my early 20s. Well, I started listening to a lot of podcasts and everybody talks about how Rich Dad Poor Dad was like their introduction into real estate. And so I was, about a year ago, I said, okay, well, maybe I missed something. Maybe let me read it again. Let me just read it again. And I read it again. I still just was like, well, this just sounds, I mean, I didn't get it. I read Cash Flow Quadrant. Rich Dad's Cash Flow Quadrant. That made so much more sense to me. And that was my book that really from the Rich Dad area kind of got me into it. I will say Bigger Pockets, they've got a ton of books and a ton of podcasts that go into all different types of investing, from apartment investing passively to house hacking to, getting deals with no money down, all those kinds of things. I tend to not be a no money down kind of guy because that's just, there's just a lot more hustle involved in that a lot of folks who already have a good job just are not willing to do. And you have to basically have a track record of success in rentals in order to secure that kind of, using other people's money. Essentially, you kind of have to already have a track record with rental properties. And then you have to establish relationships with investors who also want to invest in you and see that there's something that you're doing that they want to be a part of. So that's where I'm not as big a fan of that Rich Dad Poor Dad, other people's money thing. But there are certainly people who use that and they do it and they're successful with it. So I don't mean to disparage it. It's just not my style. So yeah.
That makes sense. I'll definitely keep that in mind. I'm actually getting ready to read Cash Flow Quadrant as well. So I'm hoping I'll get some insight from that.
Cool. Yeah. I liked the book and I felt like it was very introductory into just changing your mindset about how you think about how you make money and how money works for you. So, yeah, I tell you what, I'm going to look at my emails real quick. I just sent some folks a bunch of things. So, let's see. Thoughts about the rental market in the coming weeks and navigating the rental payment moratorium. So, rental markets, all real estate is local, but for the most part, I think we're poised to really come back. Now, cap rates are compressing, which means that, apartment deals are becoming more expensive to buy, which is not surprising. There's a lot of capital that's flowing out of the stock market and into real estate in the last couple of years as, different tax laws have changed and things have become more user friendly for people to invest in real estate as opposed to the stock market. So, yeah, that's the rental markets right now. Neil Bawa has a ton of information about his 2021 outlook for not just multifamily, but also single family. And all of it looks very good. All of those numbers look great as far as what we can expect in the next coming years, because we just essentially, shut off everything for a year. And now there's cash going out to people. We've got these enormous amounts of cash going to people, and people turned into savers in the last year. Now, whether that was out of necessity, obviously the pandemic has affected, different people in different ways. But for the most part, people they stopped going out and doing different things. The thought is there's going to be a lot more of that. People are going to kind of have an explosion into, vacationing and they're ready to get out of the house. But as far as the rental markets are concerned, a lot of rental markets that were already on the upswing continued to be on the upswing even during the pandemic. And so it didn't, what it affected was people's ability to pay. And so as far as the operators that I work with, none of them had occupancies that dipped below 85% in any of their properties. So to put that in perspective, the break-even point for most of these properties is between 60 to 70%, which means that if you've got an occupancy, let's say you've got, 100 unit property, well, you can have 70% occupancy. So that means 30 units down, not being, paid, and you can still take care of all of your debt service on the loan, and you can still make all of your payments that you need to make. You're not able to make any distributions to people, to your investors, but you can still cover all of your debt service. That's your break-even point. Okay. So during this time period, none of the occupancies went below 85%. That also translates into payments. So the operators that we worked with their residents to get payments, to work on payments. If you've got 90% occupancy and you just put a hold on, like, hey, we're just not going to raise rents, and we want to work with you. You know what? If you pay us on time, then here's a $50 gift card, to Amazon. Well, that's an incentive for people to pay on time, to prioritize paying for their place to live. And the truth of the matter is that the vast majority of people want to pay their rent. They're not looking to get a free lunch. They're not looking to get a free place to stay. They want to pay their rent. And especially if you're working with operators who are improving a property, making it a much better place to live, making it family friendly, people don't want to move away from that place. They want to stay there. So if they were just going to mooch off of them, for the time of the pandemic, then they know that they'd get evicted at the end of it. So there wasn't the incentive there for people to really mooch off the system. And, so for the most part, people were paying on time, or they worked out payment plans where, hey, if you can pay 75% of it by this date, and then we'll just collect the next 25%. Or, like, hey, let's do this for a few months where you just pay us this amount, and then we'll just tack it on to the end, and we'll figure out a payment plan for you to make up for what you weren't able to pay. So it was more about working with residents and doing the right things by them, because everybody was going through this thing together. And again, there's nothing to gain by having residents that aren't going to pay you. And so if you treat them, a certain way, then they wouldn't want to pay you, and they just want to move when everything was over. That's not the way the operators that I work with treat people. So, I hope that answers the question. But yeah, as far as thoughts about the rental market, going back to that a little bit, the numbers of the cash influx into, these trillions of dollars that the government is pumping in, it would be different if they hadn't passed these stimuluses, but they did the right thing last, spring and put this money in. Why was the stock market just, taking off after, during the pandemic? Well, it's because there was such an influx of capital into the markets, and people, instead of spending money on going out to restaurants and doing things, well, they were putting more money into their savings and more money into the stock market and things of that nature. So that's kind of where some of these numbers, it doesn't seem to make sense. Why is the stock market doing so well? Why are rental markets not falling? You don't hear about people being evicted all over the place, and it's because there was this capital that was infused into the markets that has helped to kind of lift this up. And the same is expected with the current stimulus. And so we'll see if that ends up being enough. But for 2021, it certainly seems like it's going to be enough to keep things afloat and keep things going until the true markets really pick back up. I hope I've answered everybody's questions. Anybody have anything else to ask? Well, let me see. I'm going to take a look here. Look into some of these different things about advice to give to folks. So let me find. Oh, you're very welcome, Matthew. Very welcome. Books and resources. Here we go. Oh, so here we go. The Perfect Investment by Paul Moore. So he actually, Paul Moore has been a multifamily investor for many, many years. And he wrote a book now. Granted, it's a little dated. It's about 8 years old now. But it's something that is a great book that kind of goes into the details of multifamily investment and why it's a good investment. And its prospects, obviously looking forward from that point. Now, multifamily is still a good investment as it was back then. It's not, everything's kind of cyclical. So as I mentioned, cap rates are compressing, which is another way to say that properties are getting more expensive, but things are moving out to the secondary and tertiary markets. And that's where more of the deals are. And a lot of your operators have in the past been looking at 100 units or more. So you're going to start to see the markets heat up as people start to look at the smaller areas, 30 to 70 units. And because that's really where a lot more juice is left in the squeeze, if you will. So another book is The Hands-Off Investor, An Insider's Guide to Investing in Apartment Syndications by Brian Burke. And then another one is Passive Investing in Commercial Real Estate. I tell you what, let me just copy these and put them in the chat. And that way everybody can kind of see. There we go. Those are the 3 books. So if you're new to this, what you can do is you can click on the little 3 dots in the chat down there at the bottom, and you can click on Save Chat. And that way you've got those, or you can just copy them yourself. So now there are other people who have good, good guides. So Michael Blanc has a free guide that's basically an ebook that's really useful. You just have to give up your email address. So I'm going to put a couple more links in here, and that way you guys have got it. And there we go. So yeah, and then there's also Ellie Perlman has a really good post on the multifamily investment process. So hope that helps you guys out. As I said, there's a lot of different ways to do this, and you can find out different information on how to do this. One of the things I've been interested in lately is the idea of fourplexes, and, using those as a way, because what you can do as an individual investor, if you don't want to, say invest in apartment buildings per se, but you want to build up your own personal portfolio where you own the properties yourself, um, threeplexes, fourplexes make a lot of sense because you can still do residential loans for those and still get, the residential loan rates, but you are also, still benefiting from the economies of scale of having multiple renters in your units. So those can make a lot of sense for an individual investor. Now in my area of North Carolina, I don't have a whole lot of multifamily, there's the smaller multifamily, the duplexes, triplexes, quads that, you might find in other areas. So, just check out your local areas and see what makes sense for you. But, I view, if you're investing in fourplexes, I still view that as multifamily. If you've got, uh, 6 or 8 of those, you're scaling, you've got economies of scale that are beneficial, and one vacancy is not going to hurt you. And I think that's kind of the goal in all of this, is to get up to a point where, one particular vacancy or one particular property is not going to really affect your overall portfolio. Any lessons learned since I've been involved? Ooh, I've learned a lot of lessons. Well, I'll start off. So, I tried a single family rental first. Okay. When I was growing up, my parents were into, single family rentals. So my dad had a condo and a couple of houses. And so on the weekends, we would go, I lived in, Warner Robins, Georgia. And so it was about a 5.5 hour drive to get down to the Tampa Bay area where the rest of my extended family was and where the rental properties were. So, it would be something where, hey, we're going down to Florida for the weekend. And, we'd end up going and turning over a property after a tenant moved out, and instead of, hanging out and by the pool and sunning ourselves. So, we basically, I learned that, from that experience, it was, man, the only way to make money in real estate is if you, go and you put in that sweat equity, and you're going and painting walls, and cleaning bathrooms and, ripping up carpet and replacing it after a tenant and that kind of stuff. And so I'm not a handyman, and that made me real gun shy, for a very long time when it came to real estate, because I had no idea that there were so many other ways to make money in real estate. So that was a lesson that I learned that I had to unlearn, because I'm still not a handyman. I'm still not going to, I'm not going to go down and turn over a property. So that's where you have to do right on the buy. You have to buy a property, right. And then have people that are working on the property that and trust. You have to have a team. It's a team. All of this is a team sport. And that's the cool thing, is that everybody on the team can really benefit along the way. And that's one of the lessons I've learned. When it comes to the, my first single family rental, we bought this property. It was supposed to be a turnkey property. Ended up not being quite so. And I didn't trust my gut. There were some things going on that I was like, well, but you're dealing with the banks and they're being a pain in the butt. And so it was like, well, we're going to plow forward and this is going to be great. All the numbers on the spreadsheet, the spreadsheet's telling me this looks great. Well, the numbers were completely off. I didn't know my market. I didn't vet properly the area surrounding where I was buying. I didn't do a proper analysis of property values around that property and rentals, what other properties were renting for. I made the mistake of putting too much trust in what somebody was telling me rather than what I could find out on my own. And so that was one of the lessons that I learned was, wow, I made a big mistake. And they put me with a property manager. And this property manager, it was a horrible situation. I couldn't get the property rented for about a year. because we went through property managers and stuff. And I had to choose a different property manager after that one kind of dissolved and had a big blowing up of their whole business. So I had to go in a different direction, started all the way over, and then we were finally able to get the property rented. Now, right now, it cash flows for us. It's makes money. But during that time, we replaced an AC unit in it that because it was stolen. You put an AC unit in, and then it gets stolen after a few months because the property's vacant, and insurance doesn't cover that because the property's vacant. So, a lot of the lessons that I've learned have been those that cost some money along the way. So, certainly something that, was nice along that way was that shortly after we bought that property, I found out about apartment investing, and we started looking at deals, and, we invested in a deal, and a couple months later we were getting checks into our account, and it was like, okay, well, this was a ton easier than working through a bank. You just wired money over to the operators, and, they took care of everything, and we were getting paid from that well before we ever got paid from our single family rental. So that worked out for us. There are plenty of other people who have single family homes and single family portfolios that work great for them. We had a bad experience. I wouldn't necessarily shy away from getting a single family property again, but I know that there are a lot of things I do differently the second time around. And there are a lot of things that I took from that and I applied to vetting these operators for these apartment deals. So yeah, you're welcome, Courtney. Great to have you here. So yeah, I hope that answers your question, Fonda. And if you have any other specific questions, I'd be happy to answer them.
How does one, other than Google and research, learn about the types of apartment investing and syndication, and maybe having made previous mistakes in other investments that I thought I knew but didn't know so well, and being hesitant to get into much of anything of giving it other people my money? What are some, other things you've shared, like things you look at in particular and do the market research, but as far as the business plan being proposed, and then the return on your money, you said the average is about 14%. It's, let's say, 3 to 4% higher than the stock market, but then your money's tied up for that amount of time. So is that consistently higher than market investing?
So the thing to keep in mind, when I say 14%, while the investment itself is not compounded, the returns are calculated as if it was a compounded investment. So if you were to get 14% compounded returns in the stock market over a 5-year period, you would essentially double your money. And that's the goal for many of these. So if you look at an equity multiple in an offering, that's going to tell you what the expected multiple is of your money at the end of the investment. So you'll see numbers, if it was 14% on the dot, it'd be 1.96x at the end of a 5-year period, so that's something to kind of keep in mind when you're looking at these deals. Now, when I'm vetting a deal, I look at how quickly can I get my money back? How quickly can I get my money out of this investment? So that's generally how I think about it. So if you make $100,000 investment in something, then the goal is, okay, well, let's say it's 8% returns. Okay. So in the first 2 years, you get 16,000 back. They do a refi at the end of year 2. And so then you get another, let's just say 30,000 back. Okay. So now you've got $46,000 back of your money out of the original 100,000. So when you say that your money's tied up, well, it can be, if they take that whole first year and don't give you any returns, then yeah, your money's tied up for that whole first year. You're not getting any benefit out of it. But if you put that money in the stock market, are you getting benefit out of it? I mean, you know, the S&P 500, I think, has a 2% return if you just invest in SPX. A lot of them are less than that. A lot of them are closer to 0.5% or 1% dividends. You know, when people talk about dividend aristocrats in the stock market, I mean, these are dividends that are 2 to 3% at most, you know, typically. So you're not getting a huge return back at that time. So that, I mean, I guess that's the way I look at it. When I talk about stock market investing, I'm looking at long term. You know, it's not something where I want to invest in the stock market and then be taking it out a year from now. So that's a completely different thing. That's more of a long-term view. When it comes to apartment investing, I'm looking at more of an intermediate term, 5 to 7 years. That's an intermediate kind of time frame. Versus something like flipping a house, you know, where that's more of a short-term investment where, you know, you put your money in and then you know, do all the work and then you get that money back out within, you know, 3 to 6 months, the average being 6 months for that. So that's kind of, you know, that's where I would come down on that. I don't know. I'm welcome to any more specifics that you'd like me to get into there.
Is refinancing within, let's say in your example, 2 years, usually part of the plan?
So I don't want my numbers to be based on that when I'm looking at a deal, but some operators will include that, some won't. It just depends how they want to, you know, look at their numbers. But typically you can expect the operators to want to do that, to want to give you your investment back, so long as it's beneficial to, you know, to the deal, you know, so long as it's beneficial for them to do the refinance at that time. So most of the time that happens. Most of the time they are pursuing a refinance at that time. You know, part of it is because the operators themselves, you know, they'll get some of their money back out of the deal too, and then they can go and reinvest it. You know, so that's where them having their own money in the deal works to your advantage, because they, you know, everybody's in the same boat. So they have an encouragement to get that done as well, if that makes sense. Because they don't, you know, they don't want to have their money just stuck in a deal that they can't get out of. But at the same time, so you look at deals, you see how high the cash distributions are. You see how, if that changes over the time of the deal. Some deals you might have that start off the first year and it's only 4%. And then by the end of year 5, you're getting 10%. And that makes up for that first year, but you're pushing off some of those returns to the end. I feel more confident in deals that are giving you a little more upfront. You know, and that's just where I'm at as an investor. Not everybody's there. A lot of people say, well, 5 years, that's nothing, you know, and I'll gladly wait for higher returns, you know, in this particular deal. So it really just depends on what you're trying to build and, you know, with your investment portfolio.
Yeah, it seems a little bit more intimidating thinking about apartments and complexes, and syndicate's a fancy word. So
Yeah, I understand that. You know, and I will say, if you have any questions, I'm happy to answer them. I know that the series that I've sent out, it does have a lot of information in there, and a lot of that stuff, you know, I think I've realized that my mistake with that series is that I thought that everybody would want to know all the nitty gritty like I did, you know, and I think that sometimes that can be very intimidating for folks that are just getting introduced to this and they don't quite understand it. So I'm working on kind of reformatting some different things and doing some different things with that to make it a little bit more palatable for most folks. You know, because a lot of folks aren't coming from it, you know, from my perspective of just being like, oh man, I got to get into this and I want to know the details and I want to know everything about it. You know, a lot of people are like, well, I want a safe place to put my money, you know, and I want to be able to diversify out of the stock market, and I don't want it to be complicated. You know, I want to understand what I'm looking at here. And so,
and also trying to figure out which is the best option. I mean, I've been listening to Big Pockets for a year now, and I just feel like I'm more confused because there's so many options. I previously invested in an Airbnb thing in New Orleans that kind of went down the drain with COVID and business partner situation, but mostly
Yeah.
COVID.
Yeah.
So, you know, that made total sense at the time. There's lots of people all over the country. You rent a bunch of apartments. These were kind of higher end in like the Mardi Gras district, mixed business and residential. The apartments were beautiful, right? But money wasn't returned when it was supposed to. And then COVID and everything, you know, went down the drain. So there was something that I thought was pretty simple, makes sense. Execution turned out to be variable, and then pandemic. I mean, the only way to lose that investment at the time I went into it was we would have to lose all the leases on all apartments. Well, pandemic. So you know, there's a little bit of fear of, I think I understand, but I didn't really. So how am I going to know that I do understand whatever next thing I get into? And how do I pick which one's the safest, but with a high return, you know, highest possible return, and going to be manageable and not getting in over my head? And there just seems like there's just so many ways of doing different things. Single family seems simple, but my parents have been doing that too. And one of the houses burned down just under enough for insurance not to cover it. And I deal with that kind of thing. So there's so many things, and trying to filter through understanding them to some degree to say yes or no. I don't know, maybe my brain just doesn't work that same way. But trying to choose, I think real estate's a great investment. It's just I'm really having a hard time figuring out what to put it in. And not lose any more money.
I understand that. And I completely get that. And I will not tell anybody that you can't lose money with this, you know, like apartment investing is not foolproof. You know, you know, any of this kind of investing, you sure, you stand to lose what you put in. Now, the chances of that are very minimal. You know, you could lose money by investing in Coca-Cola, you know, but the chances of Coca-Cola just drying up and going away are pretty minimal, right? So, you know, I think it's just a matter of risk reward. And again, not putting all of your eggs in one basket. I'm all about diversification, whether that's across different asset classes, you know, stock market, you know, precious metals, apartments, all kinds of stuff, you know, the crypto stuff, you know, that's out there. The beauty of living right now is that there is so much that people have access to, but it's no different than going up to, you know, a restaurant. Would you rather walk into a restaurant that's got, you know, like those Mexican restaurants I've walked into, they've got like 100 different options, and I don't know what is what here. I don't understand it. You go into other restaurants and they've got 10 things on the menu. I got you now. I can figure that out, you know, and I'm not overwhelmed by all of those options. So I understand what you're saying. And if you do listen to, if you've been listening to Bigger Pockets for a year, you've probably heard of a lot of people making money in a lot of different ways. And that can be intimidating. I'm here to say that apartment investing can be simple. Once you figure out what it is you're actually searching for. You know, what is it? And I think that would be the question I'd have for you. And I know that we're kind of running out of time here. So, you know, I would encourage anybody to reach out to me. You know, schedule an appointment with me. You can go to oncallinvestments.com right there and you know, type in information and we'll get you set up for a call. A lot of you do receive my emails. I think there's a button at the bottom that says, you know, to schedule a call. I'd love to get into more of this with you, Larissa. You know, and just figure out kind of what it is you're really looking for, and how, you know, and whether or not apartments are a good answer for that or not. You know, and what might be better for you. I'm here to help. Oh, you're on mute.
Sorry. I don't know that apartment investing would have been something that came to mind, but then I saw the you know, talk, and I thought, oh, let me take a listen. But to answer your question, as far as me personally, you know, my risk tolerance is pretty low from having lost a decent chunk of change between well, that Airbnb one is gone. The other one is still to be determined, but I have a feeling that one's down the drain too. But just
Yeah.
overly trusting of people, one. But so really learning things myself so I understand, and maybe I don't dislike anesthesia. I don't like doing it full time. I'm happy 2 days a week. That's about my happy place with that. But you know, I have a long way to go, so I need to figure out something else before. And just have more free time. But so yeah, relatively safe with the highest possible return and not too much of a headache. Maybe a unicorn. I'm looking for a unicorn. I don't know if that exists in real estate. But.
Well, I mean, I think a lot of people would say that it does. You know, but we can have that conversation another time. I don't want to you know, keep everybody here well past the time, but yeah, I mean, I think, you know, you're on the right track. You're asking good questions. You're trying to find out information. You know, it's a matter of continuing to ask those questions before you invest in anything, you know, and if somebody's pressuring you to invest in something, then, you know, you're probably better served to just walk away. You know, you've got to invest in things on your own terms. So that would be my advice to you to kind of finish this off is, you know, don't be pressured into investing in anything you're not comfortable with. So, and don't put all your eggs in one basket. That's the other. So, anyway, well, with that, guys, I hope everybody, you know, enjoyed the conversation tonight. I certainly did. And you know, thank you guys for being here. So hopefully we'll see you next time. Thank you so much for joining me for another episode of the Plan B CRNA podcast. If you haven't already subscribed and reviewed the show, I'd be honored if you took the extra time. It really helps to expand our reach and get the word out about the show. If you're a CRNA who is interested in sharing your story on our podcast, I'd love to have you. Please email me at bobby@oncallinvestments.com for more information. This episode was brought to you by On-Call Capital. They are dedicated to helping providers like you develop passive income and generational wealth through investments in the apartment and alternative investment spaces. Feel free to check out their website at www.oncallinvestments.com and subscribe to their free educational email series. You can find On-Call Capital on Facebook, Instagram, and Twitter. You can also check out our YouTube page, where you'll find all of the show episodes along with other educational videos. Thanks for listening, and we'll see you on the next episode.